All right. Chapter 13. So chapter 13, we are focusing on long-term liabilities. Long-term liabilities. Specifically, there are two, notes payable and bonds payable. Now, if you remember in chapter 12, we did cover notes payable, and I mentioned at the time the calculation and the journal entries for short-term bonds or short-term notes were the same as long-term notes. So I'm not going to cover that one again. I'm going to spend our time in chapter 13 focusing on the new liability we have, which is bonds payable. Bonds payable. All right, so bonds payable. Also, I will be abbreviating bonds payable, BE. All right, so this is a liability, generally a long-term liability that represents amounts due to bondholders. Okay, and just like any other liability, principal must be repaid. For a bond, we call that principal amount. We call it par value or sometimes face value. Okay, par value must be repaid at the bond's maturity date. Remember, maturity date is when the note, or in this case, bond, is due plus any interest. Okay, so there you have your definition for bonds payable, amounts due to bondholders. Principal on the bond, called par value, must be repaid at maturity date. Interest will be paid, okay? Interest, and interest on corporate bonds is paid semi-annually or 2 times a year. Okay, so unless the problem tells you otherwise, you assume the bond pays interest twice a year. Okay. And of course, in order for it to be long-term, the life is greater than 1 year. Most corporate bonds are about 5 years, anywhere up to 25 years. Okay. So it's very similar to a note payable. Okay. The main difference is if you're taking out a note, right? You're the company. You generally can go to the bank. You're trying to raise money. You go to the bank. You take out a loan, right? Loan. They give you cash. You give them a promise to pay them later, basically an IOU, right? The IOU will be the principal plus total interest. Now with a bond, it's the same premise, but it's going to connect you with different investors who will then become your bondholders if they buy your bond. Okay, so it connects you with a market. This is the market. It's full of investors looking to put their money somewhere. So it allows you to raise a lot more money at once. You're not just dealing with one institution, you're dealing with all the interested investors that there are, right? So they're all giving you cash. So it's a way to more expeditiously raise funds. Okay, eventually you are going to have to pay them back. So when they give you the money, you give them an IOU, meaning you will pay them back the bond's par value, same thing as principal, plus you're going to pay them interest 2 times a year. Okay. And so that's why a lot of companies, when they're looking to raise money, they're thinking, okay, if I want to take out debt, I can go to the bank, but I can only raise so much. I'm just going to one institution. I don't have to limit myself. I can go to the US bond market and get money from all the interested individuals. So it allows me to raise a greater amount of money at one time. Okay, so that's going to be an advantage we see with bonds. Advantage. It allows the company to raise large amounts of money. Okay, much faster than just by going to take out a loan from one bank. So that's an advantage. Another big advantage of selling off bonds to raise money instead of, say, stock is that there is no loss of ownership. Okay, we're going to talk next chapter about selling stock in the company. When the company does that, they're selling ownership in the company, right? Then there's other people that make decisions, especially if they have a controlling interest in your company. Okay, if you do a bond issuance, the advantage is you're not losing any ownership. So those are the advantages. There's got to be a downside, right? So what are the disadvantages? Well, we kind of mentioned one. You're giving them, these bondholders, an IOU saying, I'm going to pay you back plus interest. So of course the disadvantage is you have to repay par value. Whereas we're going to see next chapter with stock, you don't repay the investment that your stockholders make. You don't repay it. They're giving you money because they hope they're either going to get dividends or that the stock that they purchase is going to appreciate. Okay, so that's a disadvantage of a bond. We have to repay the par value, and you must pay interest 2 times a year. And that can be hard. You have to make sure you're managing your cash flow so that you have enough cash to make 2 interest payments every year. And that can be quite sizable, right? That's an overview of bonds. We have the definition. We kind of understand why a company might take advantage of them because there are benefits offered through this type of debt instrument, right? But being aware of the disadvantages. Ultimately, it's going to be up to the company's board of directors to make the decision on how to raise capital for the company. Do they want to sell bonds? Do they want to take out a loan? Do they want to sell stock? It's going to be up to the board of directors. Most of your large companies, your Apple, your Google, your Facebook, they do have a form of corporate bonds to help finance their operations because it helps them raise a large amount of money. Let's see, the SEC said last year was another year of greater bond issuances by corporations. Most of them issued bonds in order to buy equipment or to get funds to help buy back their stock. So those were 2 of the most popular reasons a company issued bonds. All right, in the next video, we'll get to the journal entries and the calculations relating to bonds.